Welcome, everybody. I'm Paul Rodriguez from Think Trading. I'm here with Manu Choudhary, who's the CEO of DMA Link and the co-founder of DeFinity. Welcome, Manu.
Hey Paul, how are you?
Yeah, very good, thank you. What are you thinking on these markets at the moment?
Interesting. I've seen some quite troubling data, so I just thought I'd run through a little bit of the global macro and give everyone a bit of context as to how I see the lay of the land, and then maybe we can look at the charts in a bit more detail, I think. But
Definitely.
perhaps the second most troubling thing was the numbers that came out last week in terms of essentially the rate and the pace and the growth of mortgage debt. So US households, as of the end of Q2, had about $15 trillion of outstanding mortgage liabilities, which increased by about a third of a billion from memory. Now, in isolation, a trillion here, a trillion there, and pretty soon you've got a big number. So it kind of all blends into the ether. But
Mm.
what's worrying about this is that about 44% of that increase happened in the 4 quarters prior to the end of Q2. So essentially H2 2020 and H1 2021, which is slightly counterintuitive. You wouldn't have imagined that would be the case. But what's even more alarming is that this is the fastest pace we've seen this increase since Q1 of 2007. And I'm pretty sure 2008 and 2009 didn't go so well as a consequence of what happened in 2007. So this is a little troubling. I think also what is a bit of a concern is really, I mean, yesterday, all-time highs in the S&P again, which is amazing, which is in the back of what was not great economic news. So this is a bit of a concern. I think if I look at one of my favorite charts, which is American Airlines, this in my head it really does signal the true sentiment of the market. And what's interesting about this is we obviously saw a sell-off back in March of last year from about $27 down to about $10. And then we've seen it more than double in the interim, even though its earnings per share have been negative every single quarter, unsurprisingly, because airline travel is down more than 50%. So this, in my head, is a bit of a red flag. And I guess the final piece of macro data, which is slightly more political, is some really worrying comments from Joe Biden last week. So he was at a intelligence committee meeting, and he made a very interesting comment, which is that he's very concerned that the US is going to be hit by a large-scale cyber attack from a major global power, and the US will retaliate with an actual war with bullets was the words he used. So,
Right.
and it kind of fits in with some of the things we've been seeing. I mean, if you look at what's happened since the inauguration in January this year, the US has been putting huge amounts of pressure on the government of Ukraine to basically send their tanks into Crimea and take it back, because I'm sure the Russians would just say, oh, hey, sorry guys, here's Crimea back. And thankfully, the Ukrainians have been slightly aloof with this particular strategy. Thankfully, they haven't done anything. But this is a little bit of a worrying trend for this administration. I'm not entirely sure what the purpose is, but nonetheless, I think if we're looking for major geopolitical issues, well, I think this is going to be one major one.
Yeah, well, there's certainly a lot of tension between the US and various other nation states, and really wouldn't want this to get out of hand for sure. Looking at kind of closer to home, or upcoming data, we've got non-farm payrolls coming out in a few hours. So this is being recorded beforehand. So obviously there may be a big move in the markets post non-farm payrolls. But one of the interesting things about the market, as you say, it doesn't really matter what the fundamentals are. People are just looking at whether the Fed are actually going to bother raising interest rates, or what the potential for interest rates are. And as long as they're printing money, the markets seem quite happy to push into all-time highs. And it's being led by technology stocks still. And I think this may suggest that the market thinks we're going to have another lockdown. There's going to be more money thrown at the problem. But quite how long this can happen before the market starts to head into what could be hyperinflation. There's a big argument between, lots of big names as to whether we're going to see hyperinflation or deflation. It may be that we see both, like deflation first, then hyperinflation. They could all be right. But the only way to really tell what's going to happen first is to look at how the markets are reacting, and how the kind of hedges against inflation are reacting. So what would you say, Manu, about the prospects for either inflation or deflation? Do you have any preference?
Look, I'm very keen for there not to be deflation. I'm also very keen for there not to be hyperinflation, I think, which is the case for most people. So, but I think you've got to put these numbers into context. Realistically, if you've gone down to your grocery store recently and you bought anything, it's very obvious the price has gone up by quite a lot more than CPI.
Yeah.
And if you look at the basket of goods that comprise CPI, it's an ever diminishing number. Let's remove butter because that's gone up by 100%. Okay, because no one consumes butter, right?
No, not at all. It's bad for you, apparently.
Energy is too volatile. Let's remove this. So you have a metric for inflation that doesn't really, it's not really fit for purpose. It doesn't measure anything. And there's a really interesting website called shadowstats.com, and they essentially look at methodology that was used in the late 80s during the Reagan administration, and they use the same metrics for today. And looking at those numbers, CPI isn't 4.1 or 5.1. CPI is probably more like 15 to 20%.
Well, it certainly feels like that. And you've got asset price inflation as well, haven't you? So, and that's where stocks are very, very sensitive. And we've got the American airline stock that you were talking about, and this is a very interesting chart because, of course, you've got the COVID collapse in March of 2020, and then you look at how it's rebounded, but it's only come back to there's a little gap in there. So markets come back to these gaps, and they act as resistance. It's literally touched that twice and come straight off. So it's in line with what you're thinking, that there is no real recovery there. There may be a bit of risk on, but if you compare it to the rest of the market, it's doing really badly. If we put on United Airlines, this is even worse. I mean, if you look at the relative breakdown point, which is here on the chart, I don't know if you can see, it's $77. It's trading at 47 right now, and this is not a particularly nice upward trend. This is a market that is struggling to make new highs. If you want to see a market that looks bullish and will probably push into new highs and lead the market into new highs, this is what it looks like. This is a bullish chart, and I'm showing you Apple here. And this is what we call a symmetrical triangle, which is normally a consolidation before the market moves up. So when it comes to technology stocks, let's have a quick look at Microsoft. That's gonna break into new highs again. So we got this disparity between the market loving technology stocks and some of the pharmaceutical stocks pushing into new highs, and you've got the kind of the travel stocks, as it were, that seem to be completely vilified because there's nothing but talk about climate change at the moment. So everything is climate change. Even the central banks are moving to talking about climate change. So you're going to be made to feel very guilty for driving your car or flying anywhere. And it seems like that's going to become more difficult, not easier. So that
I agree.
That could actually explain why they're underperforming so much. Where I would look for other signs of potential inflation, there's arguments for and against gold as to whether it is an inflation hedge or not. My view is that if there's international tensions, geopolitical risk, and there is inflation, you should see a move up in the gold price, even if it's temporary. And gold hasn't really performed that well this year. It's been in a sideways range, but I don't think that's going to remain. I think we will see, although I think there will be a retracement. I think eventually gold will be in a massive bull market. It's going to take out this high here, the 2000, just below 2100. And it's going to be shooting up towards 3,000. But I don't think we're going to see a big move until next year, because some of the gold market, some of the precious metal markets are looking a bit weak, and they normally, in a bull market, they all move together. So for the moment, I'm expecting a bit of a retracement. And you mentioned that there could be geopolitical tensions rising. That would normally imply the dollar will rally. So if that does happen and the dollar rallies, it will put pressure on precious metals and other markets.
What's interesting to note about precious metals specifically is if you look at the high, which was, as you kind of mentioned, just below 2100 in August of last year, What's interesting is the reason it began to come off. And if you look at the data, the reason it came off was because you saw a huge amount of selling by sovereigns, Asian sovereigns. And they weren't selling because they suddenly changed their view on gold or they suddenly disliked gold. They were selling because of the horrific effects of their economy on the lockdowns,
Oh, right. So
and
they're having
they
to
were
raise
desperate for
money.
cash.
Yeah, yeah.
Yeah, so they basically were using their store of value and dumping it in the market again, not because they wanted to, but because they had no choice. So I genuinely think this is a cyclical bear phase and what is a bull market. And what are we with maybe 3.5 years into this bull market? Precious metal bull markets last on average a decade. So I think we've got a hell of a lot more to go. But I agree. I think it's probably going to tread water for the rest of the year. But I think it will go parabolic at some point. Not quite as much silver. Silver I'm far more bullish on. Obviously, crypto I'm exponentially more bullish on.
Yeah, I think that's a really interesting point. I mean, silver did nothing and then exploded higher, and then we got a lot of excitement around $30, and it's just stopped. Now, this is usually quite a good technical pattern. It would normally suggest a move higher because you see these lows, they're all ascending. As long as they're ascending and they keep that pattern, the breakout should be in the previous direction of the sharp move, which would be to the upside. But so far, we're stuck in a range. And if you look at the relative high of silver compared to gold, it's really still quite far off its all-time high. Well, gold is relatively much higher. So this should be really up towards $50. So quite why it's underperforming is not completely clear at the moment. But there is time. And like you say, I think the way silver tends to trade, it will underperform, and then suddenly, bang, it will snap into alignment. So I think keeping an eye on that is very important. And in the weekly, I talked about platinum, and this is the chart of platinum. So you can see that there's quite a few things that have happened here. We've got support and resistance around this just over 1,000 level, which is psychologically important, but it's also important because the market has respected it as resistance and also now as support. We've got a downward trend that's starting to accelerate, and it's breaking through support even as we speak. So this is not a bullish chart, and it would be unusual for the other precious metals to rally significantly whilst this is behaving like this. So I think this is leading the move in the other precious metals. And once this finds some support and turns around and moves back up again, I will be far more comfortable with a bullish call on precious metals. But it is something that I like longer term, and I totally agree with you. And you also mentioned cryptocurrencies, which of course are of great interest. And I am very bullish long term. I'm just trying to work out whether we're going to see a whether we're going to see a correction in the markets, like a big correction, before we see a major bull phase again. And we were looking at the potential. Let's just get the chart up. See, this is my weekly chart. So these are the levels that I'm looking at, which I think are important to follow, to tell us that the market is moved from a potential bear phase into a bull phase, which at the moment I'm not expecting that. I think this is a downward trend and will continue downwards. And once that's over, I think that the bigger trend will kick in. But we've got a trend line break. We've got key resistance of just over 42,000. It's been tested once. It's coming back for another go, which is quite impressive. Now, if it does get through this 42,600, I think was the high. If it gets through 42,600, that will make me sit up and take another look at this as a potential move higher. But I'm for the moment, I think this is range bound, and we'll head back towards the bottom of the range, potentially break it, especially if the dollar's rallying for whatever reason. But longer term, I think there is so much upside potential, especially in other coins. And although Bitcoin is the best known, it's not the best technology, as you will know, but not all investors know that. I think it's a bit like the Mona Lisa. It's the best known painting, but it's not necessarily the best painting. And so Ethereum is a better technology, and that is outperforming. So it's probably better on a spread to be holding the market that will potentially be the leading technology, as opposed to the original, which is better known, but not necessarily, got the same future. But all very interesting stuff.
But I think to be fair, that there's two slightly different use cases. So it's very obvious to me that a lot of people wrongly think that Bitcoin is the future of money. It's not. It's not fungible, and it's not private, so it can't be a replacement for gold in that sense. But it is a store of value. Now it's a weird store of value because gold is a risk-off store of value, whereas Bitcoin is a risk-on store of value. Ethereum has got far more utility, but to be honest, I'm way more bullish on Cardano. Cardano's got to be one of my favorite techs out there right now. Don't get me wrong, I love Vitalik. I think he's a genius, obviously, but I've got to be honest. I think I'm a bigger fan of Charles Hoskinson than I am of Vitalik. But interestingly, so in terms of your view, I mean, my view is similar. I'm expecting there to be another test of the low, 28,800. I think we got to a couple of weeks ago. I imagine that's going to be tested one more time before we shoot up. Your view is slightly more bearish, and what's interesting is the equity markets look as though they are beginning to get into a point where there's going to need to be a correction. I mean, look at the S&P 500. The bottom 400 have been in a bear trend, but whilst the top 100 have been exponentially growing. So that's something I don't think they can continue forever. And I think also if you look at the amount of money printing that's been going on, it's only 120 billion, well, only 120 billion dollars a month by the Fed. They've got, what is it, 80 billion in treasuries and 40 billion in any old crap you're willing to sell them, basically, mortgage-backed securities or anything of that nature. So this number, I think, needs to increase, and they need to be given a reason or an excuse to do this. And I think the only real way they could justify is if we saw a bit of a correction in equity markets and we saw a bit of a run in the bond market.
Yeah, I totally agree. I think we are in the final phase of this bull market. Fragmentation is never a good sign. Like you say, there are certain sectors that are just not following. Some of the bank stocks aren't performing particularly well, and technology is leading, but that it can't hold the whole market up. So it really is a question of when people decide. Actually, the, the way it works is, if the economy starts to do well, you end up with a situation where the Fed have to raise interest rates. If the Fed raise interest rates, the bond market comes off, and they'll start pulling money out of stocks. So there is a kind of self-defeating purpose of trying to make the economy recover, because you end up having to raise interest rates, which conversely will be negative for the stock market. But at the moment, there's only one focus, and that's how much is being printed and how much can you stick in the stock market before interest rates go negative. And what sort of risk are you willing to take buying bonds, sovereign bonds of other countries, in order to find a yield? So you can understand, with everything at zero and less than zero, that money gets pumped into the market. But at some point, the fundamental snapback has got to happen. It's just a question of when. And in that regard, looking at the VIX index is very important. This is the volatility index of the S&P 500, and it has periodical rallies as the market sort of gets a bit nervous and starts to worry about all the things that you've mentioned, Manu. And so at the moment, it's looking pretty well behaved. And I think it may even come back down towards the kind of 15 level. But I'm seeing a potential pattern here that will push it back up. And in terms of time frame, perhaps at the beginning of September. So I think August may actually end up being a quiet month, and September could be when the fireworks start.
Yeah, I see. Yeah, that kind of makes sense as well. And sorry, I realized I didn't answer your question on deflation. I started talking about tech instead.
That's
Um,
okay.
my view on what's probably going to happen is I think we're already seeing some pretty serious issues and some pretty worrying distortions because of inflation in the broader economy. I think the interesting thing about the tech stocks moving higher is that, of course, let's not forget, technology is massively deflationary. I always find it crazy that people expect their televisions and their computers and their laptops to decrease in price, but they're absolutely fine paying more for their loaf of bread. Well, but technology is supposed to reduce the price of things. So eventually, I think the evolution of tech will basically the rate of inflation will outpace the inflation that can be created by printing this infinite amount of money. And if you look at the stats, they're quite concerning. So between 2000 and 2020, you had about 85 trillion of debt that was created in the global economy that generated 45 trillion GDP. In the next 3 years, you're going to have to see another 85 trillion of debt created in order to sustain that because of the exponential increase in the deflationary impact of technology. So I think ultimately technology is really, really going to have a negative impact on this current financial system and probably break its back at some point. Is that going to happen this year, next year? Probably not. Is that going to happen by the end of the decade? I think it's very likely. But
Yeah.
in terms of timing, it's very difficult to say.
Is it the sheer amount of debt that's just building up, or is it the amount of debt that's at the rate that it's building up, or is it both that concerns you?
I mean, look, don't get me wrong. I spent many years working in various banks across the city, and obviously we used to lend a lot of money and do a lot of leverage deals and what have you. Leverage is great. Debt is great because it magnifies your profits, but you've got to be aware that it magnifies your losses. And in a situation where you're trying to uh, basically create GDP by printing money, or essentially increasing the amount of debt that you have around your neck, that's never going to work long term. It's not possible. This modern monetary. I mean, maybe I'm taking crazy pills. I don't know. I'm not an economist, but it doesn't make any sense. And if you look at what's happened historically, when you have debt to GDP numbers above 100%, those economies never recover. They never recover. And that's the concern that I have with the amount of debt that we have in the financial system at the moment. And let's not forget, if you have a huge amount of debt, your best friend is inflation, because of
Yeah.
course this is exactly what happened in the 70s. You saw all the G7 economies got massively overextended, massively overleveraged, and what do? They had a period of stagflation where there was pretty horrific economic growth, and there was high inflation. And what did that do? Well, by the end of that period, they'd pretty much eroded the value of all of their debt. Brilliant.
Yeah.
But the problem is that it's a different situation because the amount of debt was nowhere near where it is today. I mean, look at the European market. The Europeans have destroyed their bond market. I mean, if anyone is holding European bonds, it's going to be German govies. I mean, who's holding Italian sovereign? Who's holding Spanish sovereign? Really? I mean, Greek sovereign? These are brave people, but sure as hell ain't going to be me. And you look at the entire German yield curve. The entire yield curve across the full tenor of the entire market is now negative.
Yeah.
In my head, I mean, maybe I'm not as smart as these modern monetary theorists. I don't know, but in my head, if you have a bond whereby you're guaranteed to lose money, that just sounds like a scam. I'm going to give you money, and you're going to guarantee to give me less back in
Uh,
nominal terms. Forget adjusting for inflation in nominal terms.
Well, wouldn't one want to issue as many bonds as possible? So if you're being paid to borrow money, I'd like to I'd like to borrow, $1 trillion, please. That would be great. But it's kind of it's we're used to
It
kind
isn't.
of thinking the unexpected in markets because that's what risk is. You kind of work out where things may go, not necessarily where they should go, and that can involve a better mental gymnastics. But this situation is kind of strange for lots of reasons. In as much as that, normally there's a price to pay for a government basically issuing so much money. Usually the market will be punished. So Greece was always punished for issuing, too many bonds and not having enough money to pay the taxes, or the tax take was much less, and they had a deficit, so they would issue bonds. Of course, the interest rate on the Greek bonds was always higher, and it's different to Germany. That's a problem with the euro, where everything's been pushed to one effective interest rate, or they've been able to borrow at a rate that's much lower than their actual credit risk. And at some point, that will come to fruition in the sense that either there will be some sort of internal blow up of a sovereign, or the whole system will change. But at the moment, there does not seem to be any deficit, or the market doesn't seem to mind if you have a huge amount of debt, and that goes from governments all the way down to S&P companies who are just borrowing money, buying their own stock back, and effectively making a loss on their actual normal operations.
Yeah, it's true, but I think the one thing you've got to be mindful of is that eventually you run out of buyers.
Yeah.
So look at Japan, for instance. 60% of all JGBs issued ever are owned by the Bank of Japan. 50% or 49.5% of the Nikkei 225 is 100% owned by the Bank of Japan. 40% of all gilts ever issued in the United Kingdom are owned by the Bank of England, and 30%, I think, by the Fed. These are not good numbers. And by the way, these numbers were pretty close to zero about 20 years ago. So this
That's
is not a great trend.
yeah. And there doesn't sit, like you say, there's only one way. Well, there's a few ways to get out of it. One is inflation, the other's default, and the other, I suppose, the third one is to issue new type of currency, perhaps a digital one.
Well, yeah, it's funny you say that. I think that might be where they go. Look, I think a default is out of the question. There's no way in hell the UK or the US or any developed nation is not gonna pay. They're not gonna skip a coupon. That's not gonna happen. They are going to use debt to continue to fund their government operations, because tax revenue, funnily enough, because you've had, certainly in the States, about 20% of all small businesses shut down permanently. Obviously, tax receipts have fallen. So that's going to continue. And I think we're going to see inflation be the tool to try and ease the burden of that debt over time. But it's only so long you can do that for. And I think things will probably come to a head at some point. Now, when this is going to happen, who knows?
That's very interesting, Manu. We're going to pick it up next week. And if you have any markets that you want us to talk about, ping Manu a message on Telegram or write something in the comments section. Thanks very much for listening, and we'll catch you next week.